Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to a very special green episode of Carson's Facts versus Feelings with Ryan and Sonu. This is episode 77. Sonu, we're titling this one, Why This Is Not a Bubble. Heard a lot of bubble talk. But before we get there, on the YouTube channel, people are going to say, wow,
look so silly?
Look at it. Well, people, here, I'll back up some. I mean, we're dressed for green for our St. Patrick's Day. So I've got a hat on that doesn't even fit because, again, I'm wearing my headphones, which is even funnier. I've got my green shirt on. Sonu, you've got blinking lights. Is those like shamrocks? Blinking shamrocks.
Yep. Yeah, blinking shamrocks. And I've got something that says lucky. I feel lucky.
I don't even know. Just go to the YouTube channel. I don't even know how to describe what Sonu's wearing on his head. But, I mean, there's a lot of green this year, so we wanted to celebrate. What'd you do for St. Patrick's Day? Did you guys do anything special up in Chicago?
We went out to see the Green River, so we did go on the day. So they dye the river green in Chicago. Yeah. It's the Chicago River. That's what it's called. It's
there you go.
To remember. That's the name. I think you asked me what the name of the river.
I said, "What's that river called?" I had some real unique, special name. Oh, it's the Chicago River. So easy to remember.
It's not like Ohio. We have Olentangy and Scioto and all of that. See?
Yeah, there is also the Ohio River in Ohio, though.
Oh, there is.
Okay. That's down by Cincinnati, where I am. So
yeah, I didn't know that. But no, they dye the river green, and it's bright green. It's literally the color of your hat, right? Or it doesn't blink, but like my, necklace here. But no, they actually historically they used to use, I don't know, some kind of dye, and then people complained, oh, it's not green enough, and you know which green I'm talking about.
Yes.
But now they use some sort of vegetable dye. But it's cool to see if you just Google like a time lapse video. Chicago River green. That's all, and you'll see this cool time lapse about the boats going up and down, spraying the dye or putting the powder in. And I think it brightens up after some time, like after like 24 hours, because I think that's when the powder gets to work or whatever it is, right? So it's cool. And yeah, I recorded the Take 5 video with you there, so that was fun.
Exactly. You can follow us on our social media channels on Friday, and we did a video with Sonu, dressed fairly similar right now, but in front of a green Chicago River. We didn't do too much, to be honest. I don't know, just kids and stuff. We wore some green, but I don't think we celebrated all that much. But
so you're part Irish on your background? Is that
Detrick?
Or is that German?
Detrick's German. Yeah,
it's German. Okay,
I've got German on both sides, so we're German. I do like sauerkraut and sausages and some of those. I mean, I guess a dark beer every once in a while, but
I figured that last time you were in Chicago, we hit the Publican. It was right up your alley.
Yeah, okay. Well, let's get into it because I'll start getting hungry here. So again, this is episode 77 of Carson's Facts versus Feelings. Why this is not a bubble. So we're going to talk about three things, and I'm sure more as we get going, but three main concepts, and we'll dig in. We're going to talk about why we don't think this is a bubble. Hear a lot of bubble talk lately. We're going to talk about the Fed, right? There's a Fed meeting this week. What's potentially going to happen? Probably not much, but still, what's it all mean? And then a data dump. Look at it. Some inflation data, retail sales. I know we just had a bunch of housing data just came out, industrial production. Then we're probably going to talk about Japan moving above 0% interest rates for the first time in 16 or 17 years, give or take. All right, so the first things first. Again, we've been hearing it's oh my. I just lost my hat.
Off.
Oh no! See, that's the problem. The hat is falling off. I'm getting too excited. I'm moving too much. You ever watch me on TV? I'm like boxing Mike Tyson. I'm like always moving around. My eyes are blinking. I'm trying to stand very still or stay very still to wear my green hat for this particular Facts versus Feelings. But anyway, a lot of talk about a bubble. I don't know. There's a lot of thoughts flowing through my head. What's your initial thought? Are we in a bubble or not?
No. I'll just say that. The short answer, no.
Yeah.
I mean, like my professional lifetime, if I think about, what are the bubbles I've experienced? Because I wasn't professionally doing finance in any shape or form in 2000. So I didn't really experience that from a professional perspective, right? Yes, like individual stocks, whatever. But the housing bubble, I think that was safe to say a bubble, right? And if you think about what's a bubble, I always think, you're paying for something, you're paying a price that there's no reasonable justification where for future returns to reflect the price you're paying right now, in a
Right.
sense. Right. And that's how I think about it. So when was the only other time I see that happening was really, or I saw that happening, I think you wrote about that in your blog today that's going to come out, like carsongroup.com/research. Check out
Mhm.
Ryan's blog on bubbles. 2021 February, when you had GameStop and AMC and all that stuff going up, I was like, look, this doesn't look reasonable by any logic.
Mhm. Yeah, it wasn't, but again, sometimes that's how those bubbles work. They keep going for a while,
Yeah,
and
yeah.
again, not a recommendation. AMC was one of the poster childs. The stock soared. Now it's down like 98 or 99% from where it was at the peak, and
Wow.
that felt like a bubble. What got me in the industry was the first bubble, right? I mean, everybody remembers their first bubble in this industry, I think, and it was 99. I remember I was at Xavier University. I always liked numbers, like math. My dad gave me some play money, and I started trading with it and just watching TV. And they'd mention names like Sycamore Networks or Juniper Networks or some of those names that they just said it on TV, and the stock went up a couple $100. Oh, okay. Well, they say it on TV. You'd buy it on your E-Trade account and make some money. Of course, I had no idea what I was doing, but I was making a lot of money. And a lot of people were making a lot of money. And then what happened? Obviously, the bottom fell out. Just incredible valuations on these companies that weren't even making money. They'd add the name .com to their name, and the company would just soar. Just truly crazy times. That's what got my foot in this industry. And then the market crashed, but I was hooked. I said, oh my goodness, I could have made money on the way down. Oh, in 2001, 2002, value stocks actually were up, right? I thought it was all about growth stocks and then networking stocks. Then you learn, and there's valuable lessons when you start in this industry. We all have bumps and bruises, and those were mine. But that bubble got me into it. I've been doing it ever since. And I don't know. I mean, these people that keep talking about bubbles, it's kind of, what's the old expression? When you're a hammer, everything looks like a nail, right? I mean, the same names are talking, the same names that were bearish last year are now saying it's a bubble, almost like it's an excuse. Like, you know what? Hey, this is a bubble now. It's not my fault I was wrong because the Fed's got some magic potion that they use, and Janet Yellen's got some magic button that she uses, and yeah, I mean, it doesn't feel that way. Now let's talk about a few things why we don't think it's a bubble. I'll start, Sonu, you can jump in. I mean, earnings estimates continue to move higher. We're looking at probably double-digit earnings growth this year, maybe more next year. We get it; those are forward estimates; they can change. But the last 6 weeks, we've seen S&P 500 forward 12-month estimates up 2%. Might not sound like a lot. That's a pretty big move in 6 weeks at the end of earnings season. Again, we think justifying it. Talk to me about valuations. I mean, there are some parts technology is kind of pricey. It's had an incredible run. But talk to me about valuations in general, Sonu. Why you don't think this is a bubble overall?
Look, for one thing, valuations. So valuations, when we talk valuations, the easiest way to look at it is price over earnings. What earnings do you use? Let's use forward 12-month earnings, right? And right now the S&P is, about between 21 and 22. That's above. Is that above the historical average? Yes. Again, depends on which history, right? You kind of have to pick and choose your history. Do you use the last 15 years, 20 years, 25 years? Because if you use the last 20 years, then you avoid the .com thing, and suddenly things look worse. I would say the current PE ratio looks higher relative to history. It's like 16 or 17 or something. But if you go 25 years, now you include the .com, and suddenly the average goes up, right? So again, you have to be careful when you do these things. The other side is if you take technology stocks out, right, then the PE ratio, the price earnings ratio, falls back to about 17 or 18, something like 18 times earnings. So that's what 18 times forward earnings, I should say. Right. So that's why our friends from Wisdom Tree, they have a great dashboard that looks at this stuff. So they take out like what they call expanded tech. It's not just the tech sector, but they're taking out things like Amazon, Tesla, Netflix, all that other stuff that's not technically classified as tech, right? But it goes back to something you said. I mean, when you're talking about the .com bubble, your formative experience there, right? You realize that, okay, tech stocks went down a lot, but there were other stocks that did well, relatively speaking, like value stocks. Even small caps back then did well. So again, it gets back to the idea that you don't want to put all your eggs. We all learn like diversification. Don't put all your eggs into the same basket. I think you don't have to be in finance to know that, right? And it's the same thing. You don't want to put all your eggs into the technology, and you want to diversify. Like our portfolios are diversified into we actually like small caps and mid caps. They're not as richly valued, however you measure it, right? Not as richly valued as the top tech names, or even the S&P 500 for that matter. So I think there's attractive opportunities other places.
No, well said. I mean, we've said for a while, right? One of the reasons we've got a slight overweight to small caps and mid caps. Mid caps are probably our largest overweight bet that we have with the models we run for our Carson partners. Just look at relative values, right? I mean, small caps relative to large caps are like the cheapest they've been in decades. Now, just
Wow.
because something's cheap doesn't mean that's a reason by itself to be bullish. But again, if you have some
Cheap
other
could get cheaper, right?
yeah, we've seen that throughout here. That's the other thing about bubbles. I think they go all the way up and then they come down. A lot of times you see stocks go down 80, 90, 95%. In a lot of cases don't ever come back. Now, sometimes, sure, they come back. But again, back to what I was talking about before, I got a little rant there. There really are some relatively cheap areas of the market. And again, tech is a little pricey. But talk about bubbles. I mean, the one I like to use, of course, is the mid or late 90s, early 2000s.
Right.
1999, man of the year. Times man of the year, Jeff Bezos, Amazon, right? People knew Amazon was a pretty big deal back then.
I didn't know that, actually.
Yes, so that's one of those magazines. We talked about magazine covers a week ago. Yeah, you can always cherry pick and find the perfect example of a magazine cover at the peak. And honestly, Jeff Bezos, man of the year in late 99, yeah, that was a pretty big warning sign potentially. But his stock went down, I think it was 84%. Amazon went down 84%. Wow. And I don't even believe Amazon was profitable until like a decade ago. That was one of the knocks about that company. Well, its valuations are high, He didn't even care about making money for the first 15, 20 years of that thing's existence. He's just trying to growth, right? Take over the world, worry about the money later. And obviously that did work out the last I checked.
And he's not selling books anymore. I mean, they kind of changed what they do as well, right? Like,
you're not kidding.
They have servers and the cloud and all of that. You think about Amazon being, it's the boxes that come out of in front of my house literally every day.
Sonu, they have Thursday night football. Okay, I mean, if you would have said this book company is going to have Thursday night football, maybe not. All right, so let's take a couple more things here. What was the one? So we just were up 24% in 20 weeks. Okay, pretty significant rally. I took a look, Sonu, 22 other times we'd seen a rally of at least 20% in 20 weeks, 22 times. 1 year later, higher 21 out of 22 times, an average return of up around 30% over that next year. So again, we don't think we're in a bubble. We've had this incredible move. We're still overweight and think it makes a lot of sense to be overweight. The other one, this is the wild one, day 50, the 50th trading day. It's about 250 trading days a year. It's like 252, but we'll just call it 250. Close enough for government work. We just had the 50th trading day last week.
Okay.
Up 8.3% on the S&P. That's a really good. That's like the best start since 2019. That's a really good start to. Yeah, it's a really good start to a year. When you gain at least 5%, Sonu, the first 50 days, okay, I found 25 other times that happened. So, relatively large sample size. The rest of the year, so let's just call it the next 200 days, have been higher. Are you ready? Are you sitting down? I know you're sitting down. Are you wearing green? I know you're wearing green.
And I'm feeling lucky.
Yeah, you're feeling lucky. The rest of the year has been higher, an incredible 24 out of 25 times when those first 50 days are up 5%. You know the only time it was wrong? Yeah, I'm sure you do. When was the one time stocks dropped the rest of the year?
This is like a quiz. Is it 1987?
It is 87. 87, that was a stretch rubber band. It is what it is. I mean, 87, yes. Then people say, oh, there's 87. Let's just remember the Dow was up over 40% in August for the year in 87, up about 500% from those 82 lows, the 5 years. So, listen, we've got a NASDAQ like flat since November 2021. We've got small caps that aren't even at all-time highs right now.
Say that again. The NASDAQ is flat.
Virtually flat since November of 2021, right? Is that a bubble? I don't know. I don't think so. Small caps aren't even at all-time highs, So again, that was a very stretch rubber band 87, but that was the one time it didn't work. So, I mean, this is a fun discussion. We can go on and on. Any other reasons Oh, yes, you absolutely have another reason. Sonu, this is a great one. We'll finish with this. Talk to me about like multiples. Like where do stock gains come from? Well, it's earnings, it's dividends, and multiple expansion. What I've been told, Sonu, over the past year, earnings are virtually flat, up a little bit, yet stocks are up, 20, 25, whatever percent, big percent. So it's all multiple expansion. That is a bubble. Can you push back on that?
Yeah. So if you think about returns for stocks, literally what you said, what is that? Return on stock is equal to, growth from earnings plus valuation changes, growth from valuations plus dividends, right? That's how companies give money back to shareholders, and it's the most direct way to give money back to shareholders. So from the end of 2019 through last week, stocks are up. The S&P 500 is up 71%, and this is, I don't have the numbers in front of me, so this is going to go off of memory. earnings growth accounted for 47 percentage points out of the 71%. Dividends accounted for another 9 percentage points. So we are up to 56%, out of 71 total.
Yeah.
The rest was valuation. So anytime you think about bubbles, it's like, okay, am I paying too much? What's the easiest way to go look for it? It's not the only way, but the easiest way, go look at valuations. Have valuations accounted for all the gains? In this case, not even close.
Right.
That's the story.
No, well said. I mean, again, yes, over the past year, okay, sure, there's some multiple expansion, maybe not for Nvidia and some other companies that had explosive earnings growth, but overall, you can make the argument. But if you go back, look at the longer cycle, my hat just wants to jump off my head. I tell you, I'm trying to stand still here. This hat's it's a lively hat. Anyway, where was I? Multiple expansion. So again, go back far enough. I mean, there's been earnings, and just think about since late 2019. By the way, what's happened since then? Well, 2 bear markets, right? 100-year pandemic with a 34% bear market in 6 weeks, or literally 4 years ago right now. Yeah, isn't that crazy? 4 years ago right now. Like that was near the end of the worst of at least the stock market for the pandemic, but the pandemic obviously ravaged on for a long time.
I guess March 19th, 2024. I mean, that 2020, goodness, that was not a pleasant.
Well, I think it was March. Pretty sure it's March 23rd was the low. I think
yes,
it was
March 23rd was the low, right? I was actually thinking back to like 4 years ago today.
Oh, I see what you're saying.
God.
Oh, goodness gracious. Yeah, that's and again, I've talked many times before about my birthday, October 28th, one of the best days of the year on average for stocks, one of those bullish days, I should say. Michael Batnick, obviously big fan of Mike over at Ritholtz. His birthday is March 23rd. So if you bought Mike's birthday, just always remember that one. Like his birthday was the low in 2020. So anyway, so that's pretty cool. All right. So anyway, any other? I don't know. I mean, we've kind of hammered this home. We don't think it. We think his earnings are here. We're going to talk about the economy a little bit. I mean, yes, there are some parts that are frothy. No question about it. Oh, let's finish with this, the Mag 7. Because honestly, where we're hearing about bubbles, it's usually with the Mag 7. Yet you look at the PE multiples. I mean, yeah, they're in the 30s, 40s. I think one of them might be in the 70s. But nonetheless, we're not seeing PE multiples in 100. Now, that's pricey. But there's also some growth coming. So maybe the Mag 7, you can say, is a little bubblicious. That means they have to crash. Maybe it just means there's other parts of this economy. Other parts of the investing landscape that can just do better. You want to talk about Mag 7 in the bubble? Let's wrap this up.
Are we still talking about the Magnificent 7 or Magnificent 5?
We've kicked them out. I don't know. I mean,
every day we're kicking things out.
Yeah, Tesla's down like 30% for the year, and obviously Apple's been underperforming.
Apple's down. I mean,
Google struggled too until this pop when they said they're going to work a little bit with Apple, going to team up a little bit. Yeah.
I mean, the big one is Nvidia, and going back to literally what we were talking about, what's returns, right? It's earnings growth plus valuation growth plus dividends. I mean, forget dividends. These companies don't give much dividends away, right? They're buying back stock. That's how they return cash to shareholders. But so it's just earnings growth and valuation growth. The biggest one is Nvidia. Obviously, that's the elephant in the room, right? Is that in a bubble? No, all the growth, all the returns for Nvidia over the last couple of years has come from earnings growth. It's not come from valuations. In fact, valuations have gone the other way. Valuations have been a drag on earnings. So you take Nvidia out and it's like, oh, wait, what are we even talking about? Is it just so it's literally the Magnificent One.
The Magnificent One. That's what we should call our podcast. I'm teasing. I don't know. So Dan Ives, I friend of the show, been on the show. Well, actually, we recorded with Dan already with Leap Day. We're going to have the Dan recording come out in a few weeks here. But I'll never forget this. One time Dan was up. Well, Dan's on TV all the time. Dan's like the hardest working guy in Wall Street. The guy's always on TV. And by the way, Tom Lee, obviously we love Tom Lee. Tom, did you see Tom did a CNBC hit last week, literally from the back of a cab in like middle, in like the South America. Now he had like the little fake, silly little backdrop behind him, so you didn't realize he's in a cab. But I looked at it and said, well, that's kind of okay, Tom. What's going on here? Then I heard, it looked a little like, okay, this isn't the best quality production. Then I realized people talking on Twitter that he actually did it from the back of a cab. That's funny. Congrats, Tom, on that. But anyway, Dan Ives back in May. Remember May is when we saw that first big earnings from Nvidia. Now it feels like every quarter Nvidia crushes on earnings. But people said it was like the largest earnings beat in the history of earnings beats. You look at how the stock did. Maybe it could have been. Dan was on TV like 2 days later and said, hey, listen to me. Or listen to this. The stock's cheaper now than it was, because even with that huge surge it had in May, and I forget the exact numbers, it was an incredible jump in that stock. Yeah. He said it's actually cheaper now than it was 3 days ago because it's like, you do this for a living, and you couldn't even told me the numbers, and it's like, really? Oh, wow. Yes. So anyway, yes, the late 90s was a bubble. Yes, there's probably some bubble-licious stocks right now out there. This is how it works historically. Things are a little excited, but overall with the stock market, and even at the Mag 7, we do not see a bubble. We're still overweight equities. We think this is a bull market. All right, so a great discussion there.
All right.
Let's see what do I want to talk about here. Let's go around the world for a minute. Japan this morning, as you and I are doing this, are the last major country to move interest rates above 0%. They were below zero for the longest time, 16, 17 years. I don't have any huge thoughts on this. It was coming. Remember that period of, I don't know, 3-4 years ago, probably pandemic, where they said like 17 or 18 trillion dollars of sovereign debt was negative. I don't know what that number is now. It's probably a little bit. Yeah, like a trillion or two. You're talking rounding error. Not teasing. It's still a lot, but it's nowhere near that. What are your thoughts on Japan being the last the last man standing, so to speak? Oh, and then we're going to talk about Shogun. I want to talk about Shogun speaking of Japan. This is a great segue. I won't give away too much, but you talk about this and I'll talk about Shogun.
And I have another one for you. I was thinking about you the other day when I was watching it, so I'll bring that up. But yeah, Japan, right? So it's crazy to think like interest rates. It's a reminder that central banks set interest rates, right, for the most part, and even long-term rates. Yes, the market sets it, but to a first approximation, even long-term rates are an expectation of what short-term rates, what policy rates will be in the future. That's essentially what it is. There's risk parameters and all that around that. But Japan was the last one to, until today, they had negative interest rates. It's incredible to think about that. You had to pay money for just put money in the bank.
Yeah.
That's pretty. It's almost like gold, right? Gold doesn't pay you anything. There's no interest. You have to pay for storage. Right. And gold, which is why gold is more attractive when rates are really low, because there's the opportunity cost is less. Right. So with Japan, they've gone from negative rates to 0 to 0.1. So it's not like.
Yeah, exactly.
They've gone out of negative. They're still pretty much at 0, slightly higher. There's a range, but let's talk about why. And it gets to, they haven't had inflation for a long time. Yeah, people talk about, interest rates this, interest rates that. And we've had the bond bubble, right? They've called it, because interest rates went down from 1982 all the way to 2020, 2021. It was, the big bond bubble, as they call it. But it wasn't really a bubble because interest rates went down. Why? Because productivity was low. All of that was low. Economic growth, especially over the last 20 years, has been relatively low, right? Compared to what we had experienced before. And even more so in places like Japan. Yeah. So interest rates didn't have to be high. And they had to push interest rates lower and lower to get companies to invest. It still didn't invest, right? And then now the pandemic, I think, has shifted things a lot. And I think the big shift was really wage growth. We talk a lot about wage growth and connecting that to inflation. We've with the Fed, stateside, right? But even Japan, companies negotiate with labor unions there. Labor unions are a big part of the workforce. They negotiate with labor unions. Okay, how much of a wage increase is everybody going to get, right? For the most part. And this year, they got just last week, negotiations ended and they got a wage growth of 5%, right? That's the highest since the late 90s. And that tells you, okay, the Bank of Japan is like, okay, maybe we are moving out of this low growth paradigm here. People are starting to earn more. They're going to spend more. Inflation's no longer going to be stuck at 0%. Maybe it'll be 1.5%. I think that's why they're moving out of negative interest rates.
Interesting there. And we talked a week or two ago that the Japanese Nikkei peaked in 1989, just recently back above 40,000, making all-time highs. Took a long time. But again, that was we mentioned bubbles at the start of this. I've read the history about the Japanese real estate bubble. That might have been the biggest bubble ever. We can have arguments over this, I know. But the Japanese real estate bubble of the 70s and 80s, and then it turned into their stock market bubble also, was probably one of the largest bubbles of all time. And then you look again, just 3 weeks ago, the Nikkei finally went back to where it was trading back from 89. Amazing. That's what happens after these bubbles. But again, back to Japan, they're finally starting to see some positive return or positive growth as it comes from inflation. They couldn't cause it. Even in the U.S., we couldn't even cause inflation. We probably wanted it, last decade. We couldn't do it. And then it took a 100-year pandemic and some of the things that took place after that to bring back inflation. Like you said, there's higher productivity and some positive. So the good stuff there. Now Shogun, I know you haven't watched it yet. It's pretty awesome. So I think there's 4 of them, and today's Tuesday, the day you and I record this. Okay. So the 5th one, I believe there's 10 total. What I've seen is they're not sure if there's going to be another season or not. but it's based on a famous book, and there was an actual Shogun, I think, on NBC in like 84 or 85, a movie, a show, I guess, on NBC. But it's awesome. I mean, it is. I never really liked Game of Thrones. I mean, yes, I watched it, but the
Okay.
dragons and all the
Sure.
mystical stuff, I don't know. I'm a simple guy. Give me some guns and a plane and explosion. You know, I don't need flying dragons. Although I did watch it, I liked. You know, anyway, Shogun is very confusing. They just jump right in, and it's like, first off, you know, of course, they're speaking Japanese, and yeah, you got the subtitles, but it's confusing. But again, I love listening to podcasts. There's podcasts that explain it. There's reviews, and I love learning about history. It's real, right? Of course, it's you know, some of it's, you know, but most of this is real. I mean, this is really how, you know, Japan was, you know, 500 years ago, give or take. And it's really, really cool. And now it's a little violent too. You know, it's a show. I mean, it's about Shogun, right? I mean, it's about samurais. I mean, this is the way the fourth one just ended is, you know, war is coming, right? I mean, you can tell it's there's some things that took place that these next 6, it's going to happen. And then there was an English gentleman who landed in Japan. So of course you've got him trying to get used to, you know, the just how it all works and the connections, and it's really cool. A lot of different characters, confusing to a degree, but again, you know, you can look back and read some or listen to podcasts and read. But anyway, Shogun is really, really cool. If you're not listening to it yet or watching it yet, I think you'll like it, especially if you remotely liked Lord of the Rings.
Game of
Not
Thrones.
Lord of the Rings. Game of Thrones. I never watched Lord of the Rings. I don't like that stuff either. All right. Anyway, yeah, I'm not into that stuff.
Here's one for you.
Yeah.
So I know you're a Jason Statham fan. It's nothing to do with him, but only remotely. So one of my favorite movies, not my all-time favorite, but I really like the movie, Snatch by Guy Ritchie.
Yeah.
Right? I love the movie. It was just so cool. Gangsters in London and London Underground, all of that. So there's a new Guy Ritchie series on Netflix called The Gentleman. Right? You should check that out. It's, again, similar vibe as Snatch. It's you know,
well,
London,
I saw The Gentleman.
all of it.
So I saw the movie The Gentleman. Is this a series, or this is
the series? This is a series built off of that. So similar.
Oh, okay.
Yes.
Oh, okay,
so
cool.
Guy Ritchie.
I like that.
It's you know,
all right.
a lot of swearing, obviously. There's some violence and
okay. It's Guy Ritchie. It's Guy Ritchie. You know, that's exactly. Okay, cool. Well, good stuff. All right, so everybody, this is again episode 77 of Carson's Facts versus Feelings. Why this is not a bubble. We just talked about that. So now let's bring this back full circle and talk about the Fed. The Fed, by the time most people listen to this, probably will have already done something with interest rates, actually,
or nothing.
I should say it the other way. That'll be out. They're probably not going to do anything. I guess my question is the dot plots, right? I think the dot plots been looking for 3 cuts. Do you think that's going to drop? I mean, what will they really shake the boat much from the Fed? What are you looking for here?
I don't think so. I don't think they shake the boat. The main thing people are looking for is the signal as to when is the first rate cut going to come. And I don't think the Fed's prepared to declare that one way or the other.
Right.
They're still like, okay, we want more confidence that inflation's falling. The last 2 numbers, January, February, have been relatively hot. So that completely killed any possibility of a March cut. We're not even talking. We stopped talking about that like 6 weeks ago. But we're not even talking about a May cut at this point. I always thought May was possible. I still think, okay, there's some, especially if the labor market goes down, right? Unemployment rate starts to rise over, you know, we get April payrolls, May payrolls. And if that freaks the Fed out, I think, okay, May is a possibility for a cut. But I think it has to do more with labor market weakness if that happens, right? As opposed to the inflation data. Inflation data, we'll talk about it, but I think inflation data, you know, I think everyone's putting a little too much face value on the headline numbers of what we saw in January, February. Yeah. And that usually happens, seasonality, all of that. But yeah, the Fed's still going back to what they are going to do with the dot plot. I think they'll still signal 3 cuts for this year.
Okay.
Even if they pull it down to 2, I mean, look, these are all the Fed FOMC members, I should say, put their projections for what interest rates will be, and then they're taking the median of that, right? So in December, in the summary of economic projections for the dots, 11 of them had 3 cuts, 8 of them had 2 or less, right? And so if 2 of them switch, it goes the other way. From 3 cuts, the dot plot, the median goes to 2 cuts. We're talking like marginal differences here. We're not talking a big deal. Like at the end of the day, is the economy going to hang on whether or not we get 50 basis points of cuts or 75 basis points of cuts? I don't think so, right? I'm in the camp. I think we'll see 3, maybe 4 cuts this year. I think I've always been in that camp, 3 to 4 cuts. And I'm still there, to be honest.
Yeah, on this very podcast, let's call it 2 months ago, when it was 5, 6 cuts.
Yes.
You and I discussed, and you pushed back. You said, "Yeah, maybe not." And let's talk about why, right? Well, what's going on? Well, Neil Dutt over at Renmac, he explained it. I thought he put it really well. He's like, "Hey, in 22, when the Fed was hawkish, they were hawkish. Why were they hawkish? Well, the economy wasn't doing that great, and inflation was soaring. They're trying to stop inflation. Why are they slightly more hawkish now? Now, I know we're saying there's going to be some cuts, but still, they're a little more hawkish than they were this time 2 months ago, because the economy's strong. And we're going to talk about the economy soon. So, I was on Yahoo Finance last week, and I just kind of off the cuff said this, but it's like, hey, is it really that bad if you lose a few rate cuts because your economy is strong? I don't think so, And you think about, we talked this last week on the podcast, but expectations for rate cuts have obviously gone down. Feels like every week we do this. They're pushed back a little bit, kind of, punting the football, so to speak, on when that first cut might be. But it's because the economy. We just had earnings again up 2%, forward estimates the last 6 weeks. We're going to get into some other things on the economic front here, but the economy is still really strong overall. There's no recession, and that's likely why, at the end of the day, we're not seeing any cuts. And we still think, like we said, we're going to dig into inflation probably next. We're not so sure inflation's a major issue. Like TV might make it sound like inflation's soaring back, and I've seen a lot of talking heads. Inflation's back. Maybe not. But before we go there,
they're just talking about Japan, right? I mean, Japan is 0%. That's because they have a weak economy. A strong economy needs higher interest rates. That's not the end of the world.
Exactly. Now, so that I think that's all we're going to talk about the Fed. We'll probably talk more. Actually, you know what? The next 2 podcasts, I believe, are going to be from our Leap Day extravaganza, right? We've got Neil Dutta on the docket, and then Kathy Wood also with spring break. And you're going to India. You're going to India
this Thursday.
This Thursday. Oh my! Oh boy!
I was
going to make a joke. How you flying? But we're not going to go there. We're going to get in trouble. But hopefully you get there safely, Sonu. Let's leave it at that. But anyway, don't knock on the plane. Something like that. Teasing. Gotta be quiet. Okay. Anyway, so yeah, but have a good time. So our next live podcast will be a couple weeks from now. But again, definitely you're going to love these next 2 weeks that are coming up with Neil Dutta. Neil's just amazing, and then obviously Kathy Wood is truly amazing as well. So you're going to like those. What I do want to ask you something, Sonu. I thought this is interesting. We're going to talk about inflation next, so just save it on the docket. The whole TikTok thing, right? The whole TikTok thing. I don't know the exact number of people in the U.S. that uses it, but it might be over 100 million. I've seen these numbers, like over 100 million people. Goodness gracious. Both my kids. Both. I've got 3 kids. What am I talking about?
Right.
I look at my boy. I lump my boys together. I lump them together. They've got a TikTok. So what I'm getting at, the House just voted on TikTok. 352 to 65. The TikTok needs to be sold within 180 days or less. So that's pretty much a big majority. Now the worry is, what's China going to do back? What China really sell? I don't think the U.S. is going to take that off everybody's phones. Here's what I really want to point out, though. You want to talk about some unity in our country, Sonu? Here it is. Out of the 65 people in the House that said no, they don't want TikTok to be sold in the next 180 days or less. AOC on one side and Marjorie Taylor Greene on the other. They agreed. They were 2 out of the 65. You talk about the extremes.
Are they both 16? Is that why?
That's the thing. You look at, they have both been wildly successful leveraging social media. Let's just be very clear. And it's, of course, they're like, well, let's not go make TikTok mad. I mean, that's kind of what they're saying. I thought that was interesting that AOC and Marjorie Taylor Greene actually agreed on something.
One thing you pointed out that's actually important is Congress voted to have TikTok be sold to somebody else. It wasn't a TikTok ban per se.
You're right.
Right? So I think that's a subtle thing, because when you hear like TikTok ban, which I think if you ask yourself, I imagine most older people ban this thing. Young people are like, no.
No, I say no because I know what happened in my house. They'll lose their minds. I said China's tracking everything we're doing. They're listening right now. And I maybe it's okay because my kids will riot. But it's not just that. I mean, it is truly. A lot of people leverage it. A lot of people use it. So we'll see. I mean, do you have any other thoughts on it? I thought it was funny. AOC, they're on the same side. Anyway, okay. All right, let's talk about inflation. So CPI and PPI. I think we'll focus more probably on CPI here. But that came in a little bit hotter than expected last week was the headline. Sonu, you did an amazing work digging in, as you always do, for our Carson partners and what we call Sonu's Daily Note, and then also a blog on carsongroup.com/research. In a couple minutes here, what did you find when you looked at the CPI from last week?
Headline is worrying. right? Or even core inflation, take out food and energy, that's worrying because it's like, okay, Fed focus on that. I should note that the Fed actually, their mandate and their target is actually headline inflation. Why did they look at
Right.
core inflation, taking out food and energy? Because it's volatile, it doesn't tell you much, it goes up and down, right? So, and they look at core inflation to tell them what the direction of future inflation is. And that was hot on the surface. And if you look at headline CPI, it's up 3.2% year over year. And that's the same pace if you just look at the last 6 months, annualized. It looks like we haven't made any progress. Now, one big thing is shelter, which makes up 43% of core inflation and 33% of headline. It is what's keeping CPI elevated right now.
We sound like a broken record. We've said this once or twice. Yeah.
But ex shelter, I'll just put the number. So take shelter out. Last 6 months, headline inflation is running at 1.8%. Last 12 months, headline running at 1.8%. Even core inflation, like I said, shelter makes up 44%. What do you think is going to happen, right? It's going to keep core CPI elevated. But even within shelter, there was actually good news. So owner's equivalent rent, which is basically the rent you and I pay to ourselves as homeowners. Like I'm trying to make a joke out of that, but obviously we don't. But the BLS assumes that we do. It makes up more than a third of core CPI, just owner's equivalent rent. And then there's regular rents. But owner's equivalent rent spiked in January. Everyone is freaking out. And rightfully so, because it's such a large part of inflation. Like, oh my God, are we at the start of an uptrend here? Turns out, no. It pulled back in February, similar to what we saw in the fourth quarter, right? And then the other thing for me was actually around food inflation. This wasn't really talked about. Food is important because first of all, it makes a large part of
Yes, it is. Food is important. I'll just jump in. Yes, sir.
Never have truer words been spoken, right?
Yeah, we've done 77 of these, and that's the first time I've ever agreed with every word you just said.
That's funny. But look, food makes up a bigger wallet share than even energy. And you break it down, food at home, which is groceries, and then food away from home, the stuff we go out and spend, whether it's fast food restaurants, sit-down restaurants, things like that. The good news, grocery prices have come down a lot. Last month, grocery prices were flat. Last 12 months, grocery prices are up 1% year over year, which is where it was pre-pandemic. And that's down from 13.5% at the peak. So all this to say, look, food prices are still higher than it was at the end of 2019. It's just that it's going up at a much slower pace than it was a year and a half, 2 years ago. And then you talk about food services, which I think is important. It's been running harder than groceries, right? But over the last 12 months, it's run about 4.5%. That's hot, but that's down from 9%. Before the pandemic, by the way, it was running at 3%. It wasn't like food away from home, fast food, sit-down restaurants. Inflation in that area was running about 3%. And I like looking at food services for a few reasons. So what's interesting, it's not in the core CPI basket. It's actually in core PCE inflation. Set that aside. That's what the Fed focused on for various reasons. We've talked about that in the past. So it's pushed core PCE up, quite a bit since 2021. The good news, it's falling now. You think about sit-down restaurants, right? It captures a lot of inflation. It captures commodity prices. So food prices, things like that. Energy prices too for transportation. You need diesel to for all the trucks that go around moving food from one part of the country to another. And then restaurant workers' wages. So you get that wage growth connection. Equipment costs, rents as well for restaurant premises. So all of this, it's sort of like a bellwether for inflation, food services inflation. And the good news, that's going down. So that by itself tells me that we don't really need to worry about an inflation upsurge, which is not to say every month we're going to go up, down, up, down. You're going to get those wiggles and squiggles. But, are we looking at something similar to what we saw a couple of years ago, a year and a half ago? No, I don't think so.
No, well said there. Real quickly, this is how the sausage is made. Chelsea, if you could send me the little blur. Oh, you just did. Look at that. There we go. I'm going to read something real fast here. Help us out by telling us how we're doing. Leave a review. Use the thumb buttons and subscribe if you want to hear the latest. Episode 77 of Carson's Facts versus Feelings here, winding down. Sonu, great discussion there on the consumer level of inflation. Again, yes, the headline a little hotter than I guess, what was expected. But when you peel back that onion, there really are some continued positives. And again, the OER we talked a month ago. I don't want to get too in the weeds here, but on an annualized basis, I think it was up over 7%. That came back down. We thought that was a little fluky, to be honest, and it was nice to see that come back down. As again, that's like a third of core CPI. So again, good there. PPI producer level, that also came in hot. Do you want to spend 30 seconds talking about this one, or what did you see on PPI? Then we'll talk a little more about the economy.
So we have CPI, PPI, PCE. CPI and PCE measures consumer
you've lost
prices.
Me. You've lost half the listeners, including me, I think, on that. Yeah.
PPI, producer price index, it measures what businesses are paying for other goods, for their input goods, right? And it's mostly relevant. I'm not saying it's not relevant at all, but for our purpose, it's relevant because a lot of inputs for PCE inflation, personal consumption expenditures index that the Fed follows, it comes from PPI. Things like medical services, airfares, portfolio management services, the stuff you and I are involved in every day. The good news is all this stuff eased a bit in Feb. It's still a little harder than what we saw in the fourth quarter, but I think it has to do with, at the beginning of the year, new contracts is negotiated and all of that. Stock prices have been going up, so portfolio management services fees have been harder. So, but I think a lot of this goes into reverse in March and April. Long story short.
Okay. No. Well said.
Did I keep it to 30 seconds? I don't know.
I think so. You did pretty good. Again, this all ties back to the Fed. We've got some more inflation data coming, obviously, before. Okay, so maybe March is off the table. May is, maybe not much of a chance. But again, we see some more positives on the inflation front. Some of these things come back. So does something else caught my attention. Then we'll kind of wrap this up. Jim Bianco tweeted this. There are 2 ETFs that buy 0 date expiration options. Okay. And now you can actually have 0 day to expiration options on them. Like my head exploded. I know you kind of said Twitter. It's like the VIX of the VIX or options on the VIX, and I don't even know what in the world that means. That kind of worries me though. That's a lot of leverage on things that I don't think people understand. I'm not saying there's going to be some big calamity. I want to be clear, but
I didn't even know this.
Now
I'm tempted to go look it up after this. I should have.
Maybe I just I just scribbled it down. I mean, I don't know. It caught my attention. So maybe somebody
won't even go into explaining what 0 DT.
No, I don't want. No, I don't want to. But maybe if any listeners out there understand a little bit more, let us know what you think of that. That's you can actually send us an email, facts versus feelings, VS facts versus feelings at carsongroup.com. Feel free and let us know what you think of the 0 date expiration options with options on them now.
What's funny is both of us have our background in options too, and we don't want anything to do with this.
Oh, I mean, no, no. It would be
well
trouble.
Put.
We'd lose everyone's attention, including ours. The other thing last week on the economic front, the industrial production. We've talked a lot about this. The continued issues that Boeing's had, obviously, has done a number to the airplane production that we've seen. But at the same time, you take that out, industrial production was maybe you could say the one shining star last week on the economic front. Well, along with claims, initial claims continue to move lower. I forget that is it 209,000.
It's low.
We're just simply not seeing any initial claims. We might be having layoffs according to the news and according to the headlines, but it's not. People are getting jobs right away. So again, that's why the economy is strong. That's why the consumer is strong. In our opinion, still a strong labor market. But industrial production, what did you find there, Sonu, when you looked into it?
Yeah, as you said, one piece of good macro news last week in terms of the macroeconomic data. It was above expectations. Look, industrial production, manufacturing is what we want to focus on because industrial production has mining and utilities production that's very volatile. Manufacturing is important. It fell little over 1% in January, and the worry is, are we at the start of a downtrend here? Turns out, no. It went up 0.8% in February. Expectations were only for a 0.3% increase, so that's positive. And if you think about manufacturing, I was talking about this on our Monday morning call with advisors yesterday. So manufacturing is 2 parts: durable goods, non-durable goods. The weakness in manufacturing has actually been non-durables. Non-durables, what am I talking about? Textiles, apparel, chemicals, paper printing, stuff like that. That's down a little over 1%.
Maybe hats. Is it potentially these St. Patrick's Day hats we're wearing?
Let's say businesses are not buying these as investments. You and I do.
Yes.
But the other part is durables. Now that's where business capital expenditures, investments come in. You're talking about high-tech equipment, vehicles, aerospace and parts, machinery, things like that. That's up about 0.5% year over year. In February, it was up 1%. So it's positive. Look, it's important for manufacturing know-how in America. And all of these jobs, especially durable goods manufacturing, you think about the same thing, high-tech, aerospace, vehicles, they pay more, right? And within that, look at high-tech equipment production. We've talked about the AI story, but it's good to see that
Right.
in the down and dirty. You talk about computers, semiconductor chips, communication equipment production. That's up 19% year over year. Since
Wow.
February of 2020, it's up 33%. And this is actual volumes, right? So it's sort of inflation adjusted. It's well above the 2010, 2019 trend. And then I know you and I, we put together a deck for elections as part of that.
Hmm.
Some things that won't change. One, I think what goes up and like what's going up right now and what's likely to continue going up is defense spending and defense
Hmm.
production on that side, up 12% year over year, right?
Hmm.
Production's been rising every month for 14 straight months. So that's a
Wow.
big boost for the economy. And even more so when you compare to what happened after the financial crisis. Remember, we had the sequester, Congress and the President Obama, they were cutting spending. So defense production actually fell for several years. That was a drag on GDP. We are not likely to see that. That's not happening right now, for one thing. And even going forward, post-election, irrespective of whether it's Biden or Trump, I think now we can comfortably say it's one of them, maybe.
Yeah.
Knock on wood, one way or the other. But yeah, I think defense production continues to rise. And like I said, it's a tailwind for the economy here.
Well said there. When you look at this, you can just go to St. Louis Fed, and find this free data. Defense spending as a percent of GDP recently was 3.6%. It was double that in the 1980s, and that 3.6% is like literally like a generational low. So we haven't spent a lot on defense relative to the size of our big economy. When you look at what's going on around in the world, when you look at this hard data that we're starting to see some of these things turn around. Again, this is fiscal policy, right? I mean, believe me. Most of us are skeptical about the government. I get it. But again, there are some things that you mentioned, the high tech, high tech communications, high tech equipment building and manufacturing has just been soaring. Thank you to the CHIPS Act and the what's the other one?
IRA as well.
The Inflation Reduction Act, which was really never about inflation. It was really about batteries and EVs, but hint. But nonetheless, those things have been really positive. And again, now we've got a lot of defense spending. So I don't maybe we shouldn't be super crazy about that, to be honest. But at the same time, it is what it is from the economy point of view. There can be a lot more spending. And I think it's one of the places, the left and the right agree on right now, I think, is, being tough on China, obviously, but also defense spending. I don't think it matters who's in the White House next year. I don't think the matter of makeup of Congress matters. There's probably going to be more defense spending coming, especially when you look at it as a percent of GDP. Well, Sonu, we've done a lot. Anything else on the macro front? I think is everything I wanted to talk about. Anything else you want to hit on before we honestly take a break for a couple weeks? We're going to do, again, some recordings. We've got Neil Dutta coming up next week, and then Kathy Wood the week after. Those are recordings from the live on Leap Day that we did a couple weeks ago. Actually, on Leap Day. We did it on Leap Day is when we did it. Easy to remember. Anything else you want to add before we sign off for a few weeks?
No, definitely. The episode with Neil Dutta is a good one because it brings to, it's a big top-down macro story as to what's happening in the economy now. And just to wrap up what we were talking about, look, you talked about initial claims. So the labor market is strong, which means incomes are strong, consumption is strong. Yep. That's essentially the biggest part of the economy. But we have these tailwinds from like defense production, high-tech equipment, things like that, spending on that side. And then housing's doing well too. So we have all these little icing and cherries on the cake. And we are talking about the Fed. What are we talking about? We're talking about the Fed potentially cutting rates this year. All of that is a positive. Even if the Fed was not cutting rates, they said, okay, we're not going to cut. I think we're still in a good place. But we're talking about the Fed potentially cutting into strength from so many different parts of the economy. So that's really positive.
Yeah, and I don't remember the number off the top of my head. I know I've talked about it before, and as we get to the first rate cut, we'll talk about it. But it's very rare for the Fed to cut rates when the S&P 500 is within 2% of an all-time high. But it's happened. It has happened. And again, who knows where the S&P will be if and when that first rate cut comes. But the results have been obviously not too surprising quite bullish when they cut rates when stocks are near all-time highs, like we probably will see this time, but we'll see when we get there. So everyone, again, thank you for joining Sonu and myself. Thanks to Chelsea, our producer, is always helping us get through this. Episode 77, and the exact title was what? Let me make sure I read it correctly. Why This Is Not a Bubble. Sonu, safe travels to India.
Thank
Have
you.
fun seeing I guess it's your nephew, right? The new baby,
my nephew.
your nephew.
Yeah, maybe I'll take the lights.
Oh, he'll like that. Yeah. How old is he? Like, I don't know. What, I mean, he's young.
4 months. He was born in December,
Okay.
so I guess 4 months if my math is right. Yeah.
And you've never seen him,
No, I've
right?
never
Obviously,
seen him,
they didn't come over. She came over
when she was
before he was
pregnant,
born,
yeah. And she found
maybe-
out the sex of the baby. We talked about that on the podcast
Yeah,
last
that's
year.
right.
You
That's
knew,
right.
because in India they don't do that, and you're not allowed to. With good reason,
Okay.
you're not allowed to
Yeah.
find the sex of the baby. So,
But she did it in the United States.
Yes.
Oh my goodness, you're breaking the law. Hopefully, no one from. Oh my goodness, I don't want
I
to get you in
shouldn't say
trouble
this
here.
aloud.
Yeah, I know you're going back there. They might get you. Hopefully, no one listen to this podcast over there. Although they know they do. We're in a lot of different countries. We've had a huge amount of growth the last month. So hopefully, anyway, we'll drop it. But yeah, have fun over in
Thank
India.
you.
Safe travels, and everybody. Again, enjoy the next 2 weeks of the podcast. You're going to love it with Neil Dutta and then Kathy Wood. So everybody, we'll see you soon. We'll see you after spring break. If anyone's having spring break now or in a couple weeks or so, hopefully you have a safe spring break, and we'll just see where the markets are. We'll leave it on this. Wouldn't be shocked at all if we had a well-deserved break after the incredible run we've had. Don't panic. We think it's still a bull market. Maybe just catch your breath a little bit. We're perfectly normal, and we'll be back in a few weeks live to talk about it. But we'll be with Neil next week on episode 78. Take care, everybody. Thank you. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.